Lance Ippolito joins me now. He's the publisher of The Future of Wealth on the Wealth Press Network. Lance, welcome back.
Hey, James. Good to be here.
You bet. Lance, what are you seeing down in Florida, Tampa, that is evidence of the reaction to the coronavirus and the market collapse?
Yeah, wow. As we were just talking, it's really hitting Florida hard. And you have to realize, too, Florida, we have such a elderly population where it seems to be the coronavirus is most dangerous. Like to give you an example, World Wrestling Entertainment, WWE, they have their WrestleMania here in, I think, 20 days. It's 100,000 plus people from all over the world, and it brings in massive revenue for the city. And they're thinking about canceling that, which is about a week-long event. So they're trying everything they can here in Tampa to keep the economy booming, but people aren't leaving the house. Kenny Chesney canceled his concert at Raymond James Stadium, which fits about 70,000 people. And the global markets, not just the U.S. markets, especially when you look at European markets, they're taking a massive hit on the chin. We were down 10% in the indexes here in the U.S. yesterday. Overseas, some names, especially the DAX, were even down more. And then today, specifically this morning, and the overnight session in the futures market, we had about a 1,500 point rally in the Dow futures off the lows, and we actually got halted because the futures were limit up, and the indexes, which do not get halted, like the SPY, they were up about 6%. Well, since the market opened, they've been fading. Airliners, which were up 10 to 15%, now they're basically flat. And the Russell 2000, which measures small caps, or you can look at the IWM ETF, it just went red, literally within the last 10 minutes from being up about 6%. So stocks are selling off. The S&P's now only up 1%. We're over 100 handles off the high. Nobody wants to be long going into the weekend. This is interesting times. It is very volatile in the markets. If you're a trader, if you're an investor, you really have to be patient and selective because of all the unknowns out there.
Yeah. So I guess the opportunities in terms of what's happening is at some point you can be short in and out of the market if you are have that kind of risk tolerance and expertise. But for the most part, it looks like large, long pools are pulling out their money now and under the conviction that they'll be able to buy back whatever they sell today a lot cheaper down the road. And as long as that sort of mentality prevails, and again, as long as the Fed's efforts to inject capital, $1.5 trillion yesterday, arguably as much as $4.5 trillion in the last week, fail, there's no reason to believe that there's going to be an end anytime soon, is there?
So, James, you make a fantastic point. We rallied about 1,000 plus Dow points on that injection of liquidity into the markets, and within an hour we gave back all of it. And within a couple hours in the afternoon, we actually closed on the dead lows. So the market's not buying what the Fed is doing. In my opinion, not to get into a whole Fed and political speech out there, the Fed is out of ammo. And that's what we're seeing. They could cut rates, they could inject liquidity, but the fact is they're running out of ammo, they're running out of tools to help save the market. And when you do have, Kudlow was the first one to come out, advisor to the president. You had Eric Trump, you had the president, you've had Kramer, and now you've had Steve, I call him the Munchkin Man, head of the Treasury. He even came on the television this morning, 9 a.m. Eastern time, and said, right now is a fantastic time to buy stocks. We'll do whatever it takes to stabilize the markets. It's not helping. Right. It's very fishy out there. And what I was telling people earlier today, you just don't go fishing, take a shower, and you don't smell like fish anymore. When you're surrounded by fish and you're touching fish, you're going to smell pretty fishy for a couple days after. And that's what this market seems. It's not buying really any of the Fed political heads out there. It's not buying what they're saying. It's in its own world.
Sure. Do you think that, would you think it's safe to say that the only recourse for central banks globally is direct asset purchases in stock markets? Instead of printing cash and injecting it into money markets, why not just start buying stocks, and at least that transmits a direct floor to the market?
So that's what's been getting thrown around. And it makes a valid point, putting in a floor, but what happens if the Fed starts buying stocks and stocks keep moving lower and lower? And you start having what we haven't seen, and what is the unknown is, what are companies going to do 2 to 3 months down the road? What is the effect of this coronavirus or of the economic impact from it? Will you start seeing companies cut dividends, lower earnings? Well, we've actually already seen that. Are they underestimating the impact of the coronavirus? There's so much unknown out there that, individuals can even say, well, stocks are cheap. But I go back to them, I say, well, what is cheap? Was Disney cheap at 130? Was it cheap at 115? Now it's at 92. It was just at 150. So what is cheap when you start looking at stock prices? And that is the big question out there. You could go and run, and the Fed could go and run and buy stocks, but if these stocks and if the market keeps going down, what happens? Sure. What happens if the Fed loses control and there's nothing else to do? There's a lot of question marks out there. So I really just, for the audience point of view, is be selective, be patient, and really don't go and put all your eggs in one basket just because you heard someone say this or this out there.
Right. So are you a buyer today?
So I'll give you a real life, and I'll be 100% transparent example. Last week I wanted to buy airliners. I wanted to buy JetBlue. I wanted to buy Delta. Warren Buffett's been selling puts. Warren Buffett added his stake to Delta. We all know Warren Buffett. Great investor. Lots of capital out there to put to work. Well, when I wanted to buy JetBlue, it was 15 a share. Now I think it's 12 a share. When I wanted to buy Delta, it was around 50 a share. Now it's 35 a share. So I'm not. I'm trying to be very, very selective. And eventually I do want to start scaling into positions. And what I mean scaling in is, let's say you have X amount of dollars. You don't go and put 100% in that stock. You maybe scale in 10%, then 10%, then 10%, then 20%. Divide it out over a series of time.
Yeah.
But I'm not. And maybe when we take out the lows and when we start to flush and I stop getting texts and phone calls of, hey, what are some good stocks to buy? When there's so much panic and fear out there where people are just throwing up or they can't take holding stocks anymore, that's when I really want to be a buyer. Right. I think that's soon, but there's still a lot of uncertainties. Like I just don't feel comfortable and confident just throwing darts at stocks right now, hoping the next 2 weeks go well.
Right. So if you have to sort of look out there and pick a level, where do you think the stock market? It's just as it has a breaking point on the upside, it has to have a place where it says, this is as low as I can go because there's nothing left to sell here. At least in terms of, capital pools that have been buying U.S. stocks and are now selling U.S. stocks. Most of those large capital pools, nothing's 100% stocks generally. And if they are 100% stocks, I got to think that they're nearing a 100% cash position at this point. So, as we, go lower and lower in the Dow and the S&P, I got to think that there's a number out there where the Dow starts to sort of draw a line in the sand, so to speak, and investors sort of like it's just going to stay there for a bit, and then investors are going to start to wander back in. Would you happen to have a number that you would want to throw a dart at in that regard?
So you make a great point, and I like that line in the sand example. So in the Dow, remember back in December of 2018, right around the holiday season, we had that low volume major sell-off. The Dow dropped about 4,000 points within a couple weeks. That was around 21,700, give or take about 10 to 20 points. We actually took that out yesterday. We're trading around 21,300 in the Dow. So we actually took out that previous low, which is, in my opinion, very, very scary in the Dow. So I think when you look at the Dow, it's 20,000. That was 2017 levels. And in the S&P, we still haven't reached. It was right around 2,400 back in December of 2018, and we're right around 2,500 right now. So I think we still have about 100, possibly 120 points in the S&P lower to go. But what's really caught my attention is the Russell 2000 or small caps. Now these names are very sensitive to China, making up a lot of financials, regional banks, and energy stocks. And the Russell 2000, it took out that December low earlier in the week. That was around 125. We're at 109 now. And we're trading back in the Russell where we were in 2016. So think about that. That is years of gains wiped out in a matter of weeks. That causes a lot of pain when you look at mutual funds, when you look at hedge funds who weren't hedged, so to speak, or weren't hedged enough. That's a lot of pressure, right? That's being underwater for a long period of time where I just don't see how we have that V bounce back that we normally had on corrections and sell-offs, because in my opinion, it's not tech related. And every time we've had a sell-off in equities in the past, it's because of tech stocks or tech valuations. And in this case, tech stocks are actually holding up very, very well.
Yeah. Okay, let's leave it there for now. Looks like it's more or less a wait and see kind of environment out there. And we'll come back to you next week and see what happens on the other side of darkness. We'll talk to you then. Thanks for joining me.
Thank you, James. I appreciate it.